They turn around and make the second pass from 61.70 right back to maybe 78. With the spread, it's 81. Not quite to 84. Why? If they go to 84, 85, it releases the traders. So they'll hold right around 78. Right up in here. The traders that are long here are still stuck, and they're doing the, oh, I got it, baby, it's going, and hold on. It comes in as a near miss of the high. Now, variation on that could be the pin goes above 84 and comes right back down and closes here as a hammer on the second leg. But they'll hold a number at 78 by 81. 78 by 80, 78 by 81, 82. You'll see it. If they're working the spread widens, and it becomes 78 by 86, 78 by 87. But the 78 doesn't move. That's a hold. The sell side is open, trying to pick up the orders. That action traps the retail traders, gets them to fall for the crap and validate their patterns that they've seen in the textbook. Okay, so now, sometime between 1 and 4 a.m., they're going to break out of the box. Let's say our bias is short. Let's say we have peak formation here, and they come in, consolidate. They had 3 levels of drop. 1, 2, 3. We expect the same behavior tomorrow. They come out. They issue vector candles. Understand this swipe can be one big fat railroad track and then fall back like this in 2 moves. There's your entry, or there's your entry. It can just be 2 big fat candles straight up, one straight down. It's variations on the theme that you have to understand. The job is to get the traders to fall for it. That's why it's mixed all the time. It's disguised as different things. So now, if you're watching the big board, the high goes from 61.60. All of a sudden, you'll see it blink. Bam, they hit it. It goes to like 61.72. Bam, they hit it again. 61.80. And then they tap it 4 or 5 pips for the last time 61.84, the high is formed. They quickly get off of there and drop down to 61.70. Traders that don't know anybody go long here on the pullback. They go back towards the high but fail to break the high of 61.84. They perhaps open the spread and go 78 by 85, 78 by 86, but the high holds. Identified by the way the candle closes, it ends in a hammer or ends in a spike or a pin. They then shift the zone away from the higher level traders. Our entry is here. Around 61.78, 61.75 with the spread, you grab yourself a nice position. 61.74 would give you a 10 pip range to the top of the formation. Add a few pips for good measure for the stop. I'll talk about that. There's your entry. Stop loss is right here outside the range. We'll talk about this. Still, stop loss. Just understand that's where it goes. Okay? When the high of the day holds after the things that you need to see are there. Okay, let's see. Let's back up now, okay? 5 p.m. Do I got to do this? 5 p.m. high-low reset. Boom, boom, boom. Trade in the range. Widen the spread. Between 1 and 4 a.m., you have your vector. Times 3. 1 push, 2 push, 3 pushes to form the high of the day. Same for the low of the day. It can be 1 candle straight up in 15 minutes. An aggressive move towards the stops. It could be in 3 candles. It could be in 7 candles. When they do it in multiple candles, this is how they do it. They'll go up, break the high, trade sideways within it. hang out there, hit it again. And then maybe tap it again. And then reverse. Same thing. The only difference is they added 45 minutes in the middle to piss you off, confuse you, because they were accumulating contracts and seeing what happened. Okay? They could do the second candle, not take out the high. Let's say this candle was like this, and then trade inside here, and then hit it one more time. The last tap is always mild. The last tap is always mild before they make the reversal. Why? Just enough to not spend any more money than they have to, but to pick up the stops and grab the orders on the other side. Understand, there's some type of money sitting right here, right? So when they come back in, they just go up there like this and grab it and turn it right back around. And they say, sorry about your day. They really don't even, not that polite. They don't even say that. But that's how they grab the orders. Now, you get the revert. Our entrance is here. They shift the zone in one bar, 15-minute, nice 15-minute drop. All these traders in this structure are jammed now for the cycle. When they shift the zone in a big 25-pip move, that causes the panic, the lift the stops, the quick turn on the news. Where's CNBC? Let me kick my dog. I can't believe I'm down again. That causes all those emotions and behaviors, and it makes you start to think irrationally. Okay, that's where and how they handle that to make retail traders do that stuff. To make the bad decisions, to lift their stop loss, to do stupid things with their equity. And the bottom line is they end up pocketing it. That's their job. If you understand this is coming, then your job is to wait for this structure to develop and trade it. If you understand the second pass is coming, then your job is to have the perseverance and the patience to wait for the second pass and trade the second pass. I can tell you that if you become proficient identifying the M's and W's and wait for the second pass, you will be 10 out of 10 for the week. The discipline lies in waiting for that, and I can't teach you that. I can teach you what to look for and how to see it. I can't teach you to sit on your hands until it develops. I can't teach you to be patient until that triggers. That's on you. I can show you exactly what these guys do, like a roadmap to success. It's up to you if you get on the path and follow it. I want that for all of you. Once you understand and start seeing this stuff, you can literally telegraph what these guys are going to do and project the market, and you look like a crystal ball guru. Okay? Alright, good stuff. When a SPY candle at the appropriate time is extending the high or low for the session, what I just illustrated for you. When it is pulled back, the high or low is now formed. So when a SPY candle at between 1 and 4 a.m. or let's say at 3 o'clock spikes the high or low, let's say the high, and pulls back, you went from the initial high to where this candle came to rest, or the peak of the candle came to rest, the high point of the candle. Right? Spike candle. Boom. Like this. Spike straight out. Maybe has a wick on the top. You now have formed your high of the day. Right here. When it's pulled back off of here, pulls down, you now have your high. This pullback is this forming up. Remember, I learned to trade by the numbers. I didn't learn to trade on a chart. You guys have a major edge. The guy made me look at the board and told me, okay, like the numbers I illustrated for you, that's how I learned. And I got to tell you, it's frustrating as hell. This is easier. When they hit the number, like I showed you, the 6184, right? When they pull back to 6170, that's forming the 2-point on a 1, 2, 3 setup, right? And then when they spike back up and fail to take this out on another candle, that's how the setup is laid out. That's how it's starting to play out. It's simply this. When you have a number locked, let's say 6184 is the high for today. When they come near 6184 and fail to break it, that's your high retest candle or your high retest point that allows them to absorb those orders that are needed for them to pocket some cash. So when they come near that, when they come to 61.78, 61, 70, 81, but they don't take it out, the near miss ensures that you're at the right point of the chart for the short. The near miss is part of the signal system for you to understand the signal's coming. The near miss is part of that. Now, if they take 61.84 and breach it to 61.87, now you have to understand, where do they close? That's the next question. All right? If they come in here, this is where people say, oh, what about this, breaking this? Here. If they come up here to 61, I'm going to just use lines. 61.84, and then they pull back, and they start on the second pass, and the second pass goes above and hits 61.88. That's a mild 4-pip extension of the high. Add the spread. It's about a 8 or 9 pip extension of the high. Now the next question you have to ask yourself, did they close back below after they tapped out the stops? If the answer is they closed below after tapping out the stops, the high at 61.84 is still valid. The trade is good. Because the 61.88 tap was to pick up the orders that they couldn't get that were sitting up there. It might be like 61.90 because it's a round number. People trade that. You might see it go from 84 to 90. When they open the spread, they grab the orders at 91, 90, 91, 88, like that. Understanding that is added confirmation to your trade when they make the near miss. That's the high retest candle, low retest candle. It also forms the second leg of the formation. This structure is a 30 to 90 minute ordeal. How do I mean 30 to 90 minutes? The clock starts 30 to 90 minutes when the first high is formed on the vector candle to the high. Okay, now, when they spike it to the outside, pull back, and they tap above and stay up there, if they close above the 61.88, the candle turns green and closes above, that's not the high anymore, is it? 61.84 is not the high, 61.88 is the high. You need to wait and see what happens. Understand? Wait and hang around and see if the next candle issues a railroad track and comes back below the previous 61.84. Okay, you guys with me? You okay? The board's scrolling a little fast for me. Just want to make sure you're okay. Okay, good. Understanding how they handle the high and low is the whole business. Remember, I told you the high and low is the whole business. Understanding how they handle it is going to help you get in the right direction. Okay, the 30 to 90 minute time frame, very important here. The 30 to 90 minutes starts when the high, 61.84, is set. When 61.84 is the high of the day, the clock starts here. This time horizon is 30 to 90 minutes. Why? Because they got to go down, back up, near miss, and turn over. This structure takes 30 to 90 minutes, but up to 2 hours can be seen for this to develop. Okay, now, from the second leg, time horizon, from the second leg time horizon is 2 hours from entry. 2 hours right here. Okay, if you are not in substantial profit and it's chopping around and not moving, stop yourself out and get out of there. Excuse me. Hope I didn't cough in your ears too bad. You know what? I need a sip of Diet Coke. Hold on. Okay, back. All right, so listen. You enter the trade right here on the pullback off of 84, around 78, 75 with the spread, right? You're in. You start the clock. You have a 2-hour time horizon where if they pull away and go into consolidation like this and they don't move the trade, something's wrong. Ed, you asked me, I don't know the answer, man. Something's wrong, right? You start the clock on your entry second leg, something's wrong. The contracts aren't straddled in the way that they needed.